Click the bell icon to get latest videos from Ekeeda.
Hello friends, we'll be discussing details about how to solve an illustration which is related to profit or loss on sale or disposal of asset. We'll be understanding more details into it when we solve this illustration. As we know that whenever there is a profit or loss, you have to incorporate the other details like the written down value which is compared with the sale price, whether there is a partial asset sold out or complete asset sold out. So we'll be first discussing about a problem which is related to complete asset being sold out, and in the next video we'll be able to understand details about partial asset being sold out. So let's start with the first problem which relates to complete asset being sold out. I'll note down this problem. You also go ahead and check these details, or you can make a gist of this problem in your exam sheet or rather in your papers and start solving, whether you will be able to, or just start with the calculations of working which will help you to understand how much are you able to calculate the depreciations on this. We'll be starting with the basic problem and then we'll go on the advanced part. Let's do it. So we have mentioned certain details here. We'll read out the sum for you and then we can start with the working. Messrs XYZ Limited provides the details of their machines or assets account as of the year 2015. Their year starts from month of Jan and ends from the month of December. So the start and the end is Jan to December. So this is how you are going to calculate depreciation considering this tenure. Now there are further details that are provided here which we'll go ahead and read it out. The first detail that has been provided here states that on 1st of Jan 2015, machine A was purchased for an amount of rupees 10 lakhs. On 1st of April 2015, machine B, which was purchased in the year 2013 for 20 lakhs, was sold out for 14 lakh rupees, which has been mentioned in this question. On 1st of June 2015, machine C, which was purchased for rupees 6 lakh, has been mentioned in this question. On 1st of September, they have mentioned that there was a machine D which was purchased in the year 2012 for 5 lakh, which was sold out for an amount of rupees 2,50,000. Now we have to calculate the depreciation for all these details, all these machineries that has been provided here. We have to calculate the profit and loss situation in every sale transaction. And the third thing that we have to mention, or they have mentioned rather in this question, is that the depreciation method that is being followed is SLM method at the rate of 10% depreciation per year. So this is how you have to calculate the depreciation further. Now let's go ahead with the timeline and then we'll start with the working and final procedure of it. Let's start with it. So as we can see that we have prepared the timeline here. This is a detailed timeline decision or precision that we have provided here. Let's go through it. It's in the year 2015 they have started, or they have made sure that SLM method at the rate of 10% is followed. Now what we have further done is that the date of these transactions that were mentioned in this question, we have arranged them or aligned them into horizontal order with details of every transaction listed in that specific date itself. Let's figure out how we have done it. Now let's figure the details that has been mentioned in the first date. On 1st of Jan 2015, machine A was purchased for rupees 10 lakhs. We have also mentioned the tenure and the rate. Tenure, that means from the date of purchase until the date of depreciation, how many months have passed. So for this specific asset, it has been 12 months. So depreciation will be calculated on the basis of this tenure itself. Now on 1st of April 2015, machine B was sold, which was sold out for rupees 14 lakhs. The original cost of this machine was 20 lakhs, which was purchased in the year 2013. We have assumed that it has been purchased on 1st of Jan as no other date has been mentioned here. So the tenure here will be 2 years and 3 months. That means from 1st of Jan 2013 until December 2013, 12 months. Similarly, this is the same for 2014. And as this has been sold out in 1st of April 2015, so Jan, Feb, March, these 3 months will be considered, and this total tenure will be 2 years and 3 months. So this tenure will be used to calculate the depreciation so that we can find out the written down value here. On 1st of June, machine C was purchased for rupees 6 lakhs. Now again, this machine has been purchased in this year itself. So we have to calculate the depreciation on the basis of the tenure it has been used from June to December, which is 7 months approx. On 1st of September, machine D was sold out for rupees 2,50,000. Originally purchased in the year 2012. Again, we have assumed that here the date of purchase is in the month of Jan itself. So from Jan until 2015 September, we have to calculate the depreciation. However, as the date of sale is 1st of September, so you have to calculate depreciation only until the month of August itself. So when we talk about further depreciations being provided here, this will be for 3 years and 8 months. That is the tenure of this asset. Now that we have prepared the timeline, a detailed timeline rather, let's go on to the working and figure out. We'll do each and every year, or rather each and every asset working differently so that it is not confusing for you and we can easily find out the depreciations. So basically, we'll start with machine A. So we're done with the calculation for machine A. We have clearly mentioned that the cost of the asset was rupees 10 lakhs. The date of purchase was on Jan 2015. Tenure was for 12 months. That means from Jan 2015 until December 2015, because all of these depreciations are calculated at the end of the year. That means December 2015 itself. So depreciation for 10 lakhs at the rate of 10% on SLM method gives you 1 lakh depreciation. Similarly, we'll find out the same working for machine B. So we're done with the calculation of machine B as well. We have mentioned that the cost of this asset was 20 lakh rupees. The purchase date was in the year Jan 2013. So the tenure is from Jan 2013 until December 2015, or rather we can say that until April 2015 we have 2 years 3 months. So for 2013 we have calculated the depreciation, which is 20 lakhs multiplied by 10%. The usage has been for 2013 12 months itself, so 2 lakh depreciation. Similarly, in the year 2014 it has been used for 12 months, so the total is 2 lakh again. So for 2013 and 2014, both the years we have a depreciation calculated as 2 lakhs each. Now in the year 2015, it has been utilized only for 3 months. So 20 lakh multiplied by 10% multiplied by 3 divided by 12. The reason being it has been used only for 3 months. So that gives you a depreciation of 50,000. So the total depreciation for machine B until the date of sale would be 4,50,000. We'll start with working for machine C and machine D now. Rather, we'll start with machine C first and figure out the depreciation for this specific asset. So we're done with the calculation for machine C where the total cost was 6 lakh rupees. The purchase date was June 2015. So the tenure from June 2015 until December 2015 is 7 months. So depreciation here will be calculated at 6 lakh multiplied by 10% multiplied by 7 divided by 12, which gives you a depreciation of 35,000. So this is the calculation for machine C. Now we'll start with the calculation for machine D. So we're done with the calculation of machine D as we have figured out that the total cost of this machine was 5 lakh rupees, which was purchased in the year 2012. We have assumed that it was purchased in the month of Jan. So from Jan 2012 until December 2012, it will be 12 months. So 10% depreciation on 5 lakhs is 50,000. So this is the depreciation for 2012. Similarly, for year 2013 and 2014, it will be 50,000 each. However, in 2015, this machine was sold out in the month of September, on 1st of September rather. So from Jan 2015 until August 2015, 8 months details, which is the total depreciation is 33,333 for that specific tenure itself. That means from Jan 2015 until August 2015, this is the depreciation. The total depreciation for 3 years and 8 months is 1,83,333. Now that we have calculated the depreciation for all these assets, let's figure out what is the written down value and what is the total depreciation, or rather what is the value of every asset that we have at the end of year 2015. So you can see that we have prepared the written down value for machine A and machine B. Machine A, as you know, is very simple. Cost minus the total value which we have done of depreciation gives you the written down value as of 2015, which is 9 lakh rupees. Now for machine B, the cost was 20 lakhs. Depreciation for the year 2013 was 2 lakh rupees. So the book value is 18 lakh as of 2013. Now in the year 2014, again further depreciation of 2 lakh was subtracted. So the book value which was left as of 2014 was 16 lakh rupees. Now the year in which, that means 2015, when it was sold out, the depreciation was calculated as 50,000. So 50,000 has been subtracted from the book value of 16 lakh and we got the final book value or the written down value as 15 lakh 50,000. Now if the sale was above this price, there would have been profit. If the sale is below this price, that means there is a loss. Now the sale price of this specific asset was 14 lakh, which clearly states that it is less than the book value or the market value of that asset. Now the loss here is 1,50,000. So in this transaction, we have suffered a loss of 1,50,000. Now let's do the calculation for machine C. So for machine C also we have calculated the depreciation and the written down value. The original cost was 6 lakh when it was purchased in June 2015, and the depreciation that we had calculated for 7 months was 35,000. So what has been subtracted from there, we get a total of 5,65,000, which is the value of that specific asset as of December 2015. Now let's calculate the last machine, machine D. So we're done with the calculation for machine D as well. The cost of this asset was 5 lakh rupees in the year 2012, of which we have subtracted depreciation for that year 50,000. We get a total of 4 lakh 50,000 as the WDV for 2012. Out of which we further subtract 50,000 for the year 2013 and 50,000 for the year 2014. That means a total of, out of 4 lakh 50,000 we have subtracted 1 lakh, which gives you a total of 3 lakh 50,000, which is the written down value for the year 2014. Now, out of this, we further subtract the depreciation 33,333, which is the current year's depreciation that we had calculated for 8 months. Now, the total written down value of this asset, that means the market value of this asset as of the date of sale, has been mentioned. 3,16,667. However, this asset was sold out for 2,50,000. That means we have suffered a loss again for 66,667 rupees. So this is how the calculation for machines which are sold out in the year is done, after calculating all the depreciation and then figuring out the written down value as compared to the profit and loss situation. So I hope this sum gave you a lot of clarity as to how to solve problems which are related to partial sale of assets or rather complete sales of asset, and later on we will understand few more sums of these types where partial sale of asset is done. So make sure you understand the tenure, you understand the depreciation, and you understand the calculation of depreciation considering the tenure for what it has been used. This was under straight line method. There are different methods and we'll be talking about that in the next video. So right now, thank you for watching this video. Stay tuned with Ekeeda and keep subscribing to Ekeeda.